We've got the next rate decision by the U.S. Federal Reserve coming down at 2 p.m. Eastern time, so we're less than 15 minutes away from that. We're not expecting any change on rates this time around. The question will be to what extent they laid the groundwork for a September rate cut, which is pretty much fully priced in at this point. Let's bring in Blake Gwinn, head of U.S. rate strategy at RBC Capital Markets, and Andrew Szczurowski joining us, senior fixed income portfolio manager at Morgan Stanley Investment Management. Blake, let's kick it off with you. Just a table setter on how you think the Fed will address markets that seem pretty darn convinced that September is a done deal for a rate cut.
Yeah, I mean, our view is that they don't signal it up perhaps as strongly as maybe some were expecting. I have had a bit of a change of thought over the last few days, though. I think a lot of the feedback to the Fed preview that we sent out to clients has been that people kind of agree with this view. They kind of expect him to be a little soft in setting that up, maybe not, overly commit to September. And I think that's totally fine. We've got two CPI prints, 2 months of CPI data to go until that September meeting. So, there's really no reason for the Fed to kind of box themselves in at this point. They get a free look at those, at those 2 data points. And like you said in the opening, a cut's already fully priced. So they really don't need to kind of walk markets any further there. I think what's actually where I've kind of rethought things is that, perhaps the more interesting thing coming out of this meeting is not what he says about September, because again, we're already fully priced. Everybody kind of expects him to cut in September, but really how he classifies the labor market situation, because that's what's, I think, really underpinning a lot of the views about what they do after September, how many times they cut this year, how many times they cut next year. There's a lot of people that are kind of expecting that turn in the labor market. So seeing how he characterizes that, I'm almost more paying attention to that than the direct setup for September at this point.
Andrew, is that in line with your thinking?
Yeah, no, I agree with Blake. I think at the end of the day, as Blake was mentioning, the market's pricing in over 100% probability that we get one cut by September. So as a bond market investor, that's not giving you much value in that kind of Fed funds futures contract. But at the end of the day, so that's not a trade you want to put on. But I do think that there's still value in the bond market as you kind of look out longer term. I think at the end of the day, the labor market has been softening. Inflation has been going the Fed's direction, but they don't want to back themselves into the corner. That there's no reason to kind of back yourself in today. I do expect them to cut in September. But again, you do get those 2 more inflation prints before now. So unless you think the Fed's going to cut 50 basis points at that September meeting, there's no value in that kind of, that September Fed funds future there.
There was sort of a mini tantrum over the last week because we had a former New York Fed governor and former vice chair both kind of come out and say, we need these rate cuts now. And it was especially, I guess, interesting because the former New York Fed governor had been hawkish. We definitely saw it show up kind of in the equity markets. Blake, a lot of the questions were, well, what do they know? How fast is the economic data going to deteriorate? How did you think about that?
I'm not really sure about that. I mean, the difference economically speaking between July and September is very, very, is very minimal. I think the Fed sees it that way. Powell was kind of asked a similar question at the last FOMC meeting. This idea of kind of, if you're going to cut, why not just cut now? He kind of addressed it and said very much what I just said, which is that, it's very hard to tell the difference between, one meeting to the next as far as when you cut. So I don't think, there's really a rush. The other thing is I think they get a free look at, we've been mentioning those 2 inflation prints. That's a free look at 2 more months of inflation just to make sure they're on the right track. I think going in September, I mean, that's perfectly fine if what we're looking at is a correction in inflation. I think what really drives urgency, what would make them go in July, make them start going every meeting or think about doing a 50 basis point cut, that's going to come from more significant deterioration in the labor market. And, Powell was pretty positive on the labor market the last time we last time we heard from him before the blackout. And in the 2 weeks since we heard from him, all we've really had is been positive data. So, I just don't really know where that sense of panic would have come. We didn't see it 2 weeks ago, and the data since then has been pretty positive. So that's just not something we were really looking at.
Andrew, let's talk about how it shows up in the portfolio, where you're getting constructive. We've seen these yields consistently grind lower really since April. There have been certainly ebbs and flows. How do you see us maybe finishing out the year on that U.S. 10-year? And where are some of the best opportunities out there now that it seems like we are finally entering what could be a rate cutting cycle?
Yeah, as you mentioned, look, we've come a long way just in the last 3 months. We rallied about 70 basis points. In our strategic income fund I run, we had extended our duration as rates were backing up, and we were certainly north of our competitors there. We still have a long duration tilt here. I still think there's plenty of value in the bond market. Even if they are not doing anything in July, I think the real value comes when you look at where the terminal rate is for this cycle. I think the market got way ahead of itself thinking, hey, maybe the terminal rate's only 4.5%. I think at the end of the day, there just hasn't been that much that's changed in the inflation outlook that makes us go from a terminal rate of 2.5% pre-COVID to 4% today. Again, structurally higher inflation is something we do believe because you've had this kind of near-shoring, friend-shoring at the end of the day. But I think that there's plenty of value still in the bond market if you do believe that terminal is well south of 4% like we do. I think one of the most attractive areas, you don't even have to go take any credit risk to get here at this point, is in the government agency mortgage-backed security market. I mean, this is a market that had some bad technicals with the Fed's quantitative tightening, with banks, with the regional bank issues last March. But it's one of those markets that you can get wider spreads there than you can get in triple B corporates. So you don't have to take that credit risk to reach for yield today. You can still get it there. And it's one of those markets that we think that's our kind of highest overweight conviction right now.
Okay, interesting. Blake, final question to you. We only have about a minute and a half left, but how do politics feature into all of this? No doubt Jerome Powell will, begrudgingly get a question about it, the idea of cutting into a presidential cycle. We've seen times where the bond market has sold off if Trump looks like he's in the lead because of presumed increase in spending and Treasury issuance. What are you advising clients?
Yeah, well, we actually sent out a note last week, kind of looking at that Trump trade that, at least in rates markets, seemed to be kind of a 530s yield curve steepener. We had a lot of doubts that was the right trade to put on for Trump odds rising. And, we've kind of been proven right to some extent. The relationship has broken down. We've seen Trump's odds, in prediction markets kind of fall back to where they were pre-debate. Or at least close to that level. And in the meantime, the curves continue to steepen. So that relationship and that correlation we saw from the debate through the assassination attempt up until the replacement of the candidate, that connection kind of broke down. So it doesn't seem like that's the clear bet anymore. As far as how it matters to the Fed, I'm sure somebody's going to ask, as you say. To me, that's kind of a waste of a question. If you're a reporter, he's going to say that it doesn't matter to them when thinking about the cutting cycle,
Blake
as he
Gwinn,
always does.